Good morning, everyone, or afternoon over on the East Coast, and thank you so much for joining us today. I'm Ginny Hoban, Partner Channel Marketing Manager at Microsoft, and I focus on partner profitability for U.S. partners. Today, I am so excited to welcome Mike Harvath and Mark Seeley to the call. We often hear from partners that they have an interest in learning more about acquiring another partner business or selling their business, but they really don't have that much of an idea about where to start or what are the things that they should be thinking about as they start to think about either buying or selling a partner business. And so today we've brought together M&A expert Mike Harvath, who's the CEO of Revenue Rocket, a company that supports and advises partners through M&A transactions, so mergers and acquisitions, on both sides, both on the buy and the sell side. We're also excited to have Mark Seeley on the call today. Mark is the CEO of Intellinet, who's a leading Microsoft partner who's been through a transaction himself and will be able to share his learnings and best practices with us today from that partner perspective. Today's session is one of 3 in this series, so be sure to join us next week for sessions where we're going to dive deeper into both the buy side and the sell side. And those are on Tuesday and Thursday of next week, respectively. Those are also going to be available on demand, just in case you have some holiday plans next week. And those are available about 2 hours after the session, just at the exact same registration link that you went to sign up. Today's session is expected to take the full hour, and we are reserving 15 minutes at the end for Q&A. So make sure that you're submitting your messages or your questions in the messages panel, and we'll be sure to get those answered for you in those 15 minutes of Q&A at the end. Now, before I hand it over to Mark, I would like to do a couple of polling questions because we do want to see just a little bit of information from you. So our first polling question is going to come up on the screen right now. And it is, have you ever been involved in a merger and acquisition deal in the past? So we've got a couple different options for you here. Yes, maybe you've acquired another company. You know, has your company been bought? Have you actually done a sale before? Maybe you're an employee of a company that went through a merger, but you weren't actually involved in the ownership or leadership of that merger. Or maybe you've never experienced one at all in the past, and this is completely new to you. Just going to see what our answers are so far. So most of you, it looks like, have never experienced a merger. We've got a few who've acquired another company, a few who've been bought, and a few who've been an employee of a company at the time. Okay, so quite a bit of difference there, but definitely most of you, this is a new area. All right, so let's go to our next polling question. Now we want to find out what you're thinking about for the future. So it's coming up on your screen now. All right, are you considering doing a merger or acquisition transaction in the next 12 months? So yes, you're interested in maybe acquiring another partner business as part of your growth strategy. Are you interested in selling your company? Are you just here today because you're interested in considering your options? Maybe you've got a longer time frame that you're thinking about than just 12 months. And then maybe you're not really planning a transaction, you know, truly just here to kind of get a feel of different options. And pulling up those results now to see where everyone's landing. Oh, we've got just a wide variety. I think we've got, I'm considering my options as the leader right now, but definitely some folks who are interested in selling, some folks are interested in who are not planning a transaction, and quite a few who are actually interested in acquiring another partner business. I know a lot of people are thinking about cloud growth, and that's a great strategy to consider for that. All right, so thank you all so much for your responses. And at this point, I would like to go ahead and hand it over to Mike Harvath, who's going to get into the meat of today's presentation. Mike, go ahead and take it over.
Thanks, Jenny. Appreciate the introduction, and welcome to everyone today. Look forward to sharing some insights about the M&A marketplace and what's going on in the Microsoft partner channel. little bit about Revenue Rocket, a little bit about our history. We're a 16-year-old firm based in the Midwest in Minneapolis. We're the premier growth strategy, consultancy, and M&A brokerage firm in the partner market. We focus exclusively on partner companies with a focus on IT services companies. We've worked with over 450 firms globally, and our team of consultants are all experienced in the Microsoft partner channel and with Microsoft partner businesses. You know, the question to answer is it build, buy, or sell, I think. You know, we get asked this by our clients all the time, and obviously are advising them in all three areas of helping them grow their business. We feel that all three should be on the partner's roadmap. Obviously, are at all times looking at ways to grow revenue and profit. We know that having sustainable growing profit is how you add value in your business. You know, I know that a lot of partners focus on growing top line, which is great, and it's a vehicle to grow bottom line. But in the end, having sustainable growing profit is how you, you know, have options, right? Year-over-year profit growth is really where it's at, and having a plan to scale and grow profit really should be a primary focus as a business owner and as a leader in your respective businesses. Obviously, once you have options as it relates to growing your profit, you can grow the business, continue to invest in organic growth, buy in another business, or ultimately sell and maximize your return on investment. Let's talk a little bit about building your business organically first. A little quote from my former boss, Steve Jobs. Steve and I worked together in the early 80s at Apple. You know, you have to have a lot of passion for what you're doing because it's so hard. If you don't, any rational person would give up. This was one of my favorite quotes from Steve. He clearly lived this in his professional life and took the hill many times, as you know, based on history. And I think it's a good mantra for us as partner owners to you know, look at our own business. Obviously, growing your business, you have to have passion. You have to have love. You got to love it and want to grow it, or you should leave it. I think that's important. We talked to a lot of partner owners who have said, hey, I'm really passionate about getting to the next level, and I'm investing to grow, and I'm investing to grow both organically and through acquisition. And frankly, others that are tired, right, and they want to think about an exit, or they're at a point in their career where they may be looking to at least have an organized way to wind down their involvement of the business, either turn it over to existing management through a management buyout or sell it to another suitor. We think that if you're going to grow your business, a partner business, you really have to be open to change. And that means being out with the old and in with the new. At almost no other time in our history in the Microsoft Partner Channel has there been as much change being thrust upon the marketplace today that is warranting a change in strategy and also rethinking the way that you go to market. And I think all of you would attest to that. We also believe that it's really about process first in your business and then people and technology. We know this is a little twist on the old people, process, and technology mantra, but it really is how you scale the business. And again, you'll hear me beat this drum throughout our presentation today. It's really about growing profit as the major metric. If you have to measure a metric of success, that is the one to measure. We've developed a concept called the Rule of 45. There is a theoretical growth limit in partner businesses. Many of you have probably heard us talk about this over the years. But in essence, it talks about your year-over-year growth rate as a percentage of plus EBITDA as a percentage of revenue cannot exceed 45. We feel that we know that to be the case for businesses that are at or above about $5 million in revenue. If you're south of $5 million in revenue, let's say you're between $3 and $5 million in revenue, that number is really the rule of 60. And if you're below $3 million in revenue, the rule is about 75 or 80. As you look at your theoretical growth limit. And the concept here is that you can grow at 45% top line growth, but you'll grow at that rate with no profit. Likewise, your theoretical profit maximum, most profitable partner business we've seen hovers around 30% EBITDA, but it's very challenging to grow top line at that rate. Top quartile performers in the partner channel have about a 12.5% EBITDA or greater, right? So those are the top 25% performers. And top quartile performers on a year-over-year growth rate perspective grow at more than 30%. And obviously you can look at those numbers and you can see where we're getting pretty close to the rule of 45. If you add those numbers up, we get to the rule of 42.5, I guess. But essentially the top performers are at or kind of hovering around this rule of 45 number. You know it's time to buy when your business is larger than $5 million in revenue. We think it's tough to acquire other businesses if you're smaller than $5 million in revenue. Certainly can be done, and we've certainly helped partner businesses do so. We think of those more in the concept of an acqui-hire in many ways, as a way to gather talent and clearly some customers and revenue and profit to pay for that acquisition. But for the most part, we use a rule of thumb that if your business is approaching $5 million or above, you're in a position to buy. We also add the litmus test that you have a clear organic growth strategy that focuses on a balance between growth and profit. If you're focused exclusively on growing revenue, very challenging for you to fund an acquisition, right? And at the same time, if you have sort of muted growth on the top line and you're focused on profit exclusively, certainly that's great, but it's going to be difficult to plug in, I think, an acquisition and make sense of it. You should have revenue growing at least 10% greater than the market. The market today, depending on your strategic area of focus, continues to have a healthy growth rate. And each area, a respective area within the partner ecosystems, have different, top line growth rates. That's why we say that you're taking share, and you should use the litmus test of growing at least 10% greater than your specific area of the market. We feel that in order to buy a company, you should be best in class, right? You should have best in class profit, that your processes are well defined, and that the vertical markets that you focus on are also well defined. Very, very important to do that in the current state of the state. It's also important to be financially healthy, that you have little or no long-term debt. You're going to take some risk to do a deal, to do a buy-side transaction, and you really need to be in a position to have a very healthy balance sheet in order to do that. And you should have a desire to accelerate your growth through acquisition, faster than you can organically. A little bit about buying as a competitive strategy. These numbers came out of a report from Equitech. It's a company that's based in the UK that we consider a partner. And they do probably some of the best research in the space about sort of the metrics around the market. And when we look at buying as a competitive strategy, they did a report recently that talks about, that if they poll the partner ecosystem, that about 47% are equally driven by organic and acquisitive strategies, almost 30% mostly by acquisition, about 14% mostly by organic growth, and 86% of the market is planning to grow via acquisition. So it's a pretty big number. The current landscape of the M&A and the IT industry is that we're in a huge industry, right? It's upwards of $4.4 trillion. Some arguments have that number as high as $4.6 trillion today. Some interesting facts that come out of some of that research are that 80% of all M&A deals are in firms under $40 million in revenue, and 40% of all the deals are actually in firms under $5 million in revenue. So there's a big quantity of small transactions going on out there. And in 2015, M&A deal volume grew at about 15% year over year. The takeaways there is, M&A is a critical ingredient for partner growth and expansion. And a lot of that has to do with fragmentation as driving sort of competition and consolidation. We're big believers in the sort of go big, go vertical, or go home mantra. We think that, being able to focus on a very specialized market and taking as much of that share as possible is important. And in the end, it's easier to buy than build the business organically. We know that to be the case if your desire is to grow quickly. A little bit about multiples and trends in tech services, IT services. There's a lot of discussion about multiples of EBITDA being and multiples of revenue being the way to value your business. These are simply comparative benchmarks and not valuations. Doing valuation work is a complex exercise. Anytime you're estimating the value of a going concern, there's all kinds of variables that come into place. But some of the most important takeaways is it's really all about profitability and not revenue. It's not about the length of contracts, although we know that there are some advisors in the space that talk about that. It really does not, it's not materially matter in the actual value of the business. And multiples pivot around, or really I should say transaction strike price, pivots around the strategic fit between the seller and the buyer, the blend of reoccurring revenue and profit versus one-time sort of revenue and profit, and the blend of upfront cash versus delayed payout. A little bit about trends in IT services. In 2017 Q2, the average deal was reported at about 1 times revenue or 8 times trailing 12 months EBITDA globally. That's actually buoyed a little bit by international numbers. International numbers on a multiple of EBITDA basis are anywhere from 0.8 to 1 times EBITDA higher than U.S. So just so you know, I think a lot of that has to do simply with foreign buyers and certain transactions that they fund. They tend to be a little larger than U.S. buyers. And the M&A volume is expected to grow another 10% in 2017. It's already grown quite a bit. I think the cumulative growth rate is expected to be almost 18% this year. So we are a little bit ahead of where we were in the last statistic. A little bit about average deals, cash at close versus earnout as it impacts deal volume. It's about a 60-40 split between cash at close and performance-based payouts. And these impact the value of the transaction. So when you think about the value of a business, it's more weighted towards historical value, kind of rearward-looking value, if it's more guaranteed cash. And if it's more weighted towards future value, they tend to be more performance-based payout. This is interesting to note because most performance-based payout programs actually get paid out. 76% of the time, earnouts or performance-based payouts actually get paid out at or above that target. Most people believe that earnouts don't get paid out, so do a little myth busting here. They actually do. 3/4 of the time get paid out. You know it's time to sell when your business is at the glass ceiling, that your clear organic strategy that focuses on the balance between growth and profit is established. It's a great way to obviously optimize value. Your revenue again is growing at 10% greater than the market. And you're again best in class profit, right? These will look very similar to the items on the when it's time to buy, right? And primarily because you want to look at ways to optimize value if you're a seller. You clearly are financially healthy and have little or no long-term debt. Oftentimes we get questions about debt. Debt will directly reduce your value because when people acquire a going concern, they want to acquire that going concern with no encumbrances. In many cases, you don't have an option. So if you have bank debt, the only way that you can transition that business, the assets of that business, is if there are no encumbrances. So that buyer needs to either acquire the debt as part of consideration in the deal, or they will require you to pay off that debt as part of a transaction. Obviously, you're in a position to reduce the control in the business. This is an important point. Not necessarily a bad thing. It's just that you're going to reduce your position of control in the business. Oftentimes, people who are looking to sell want to do that. And of course, there's a desire to monetize your investment in the business. We know that for most partners, their business is their single largest asset personally. And it's important that you're able to be ready to monetize that investment. A little bit about increased levers. You can increase the value of your business before a sale if you have consistent revenue growth. Very important, year-over-year revenue growth. It's not lumpy, it's not been up and down, it's been consistent, at least over the last 5 years or so. Then you have consistent gross margin growth, right? Obviously that should track with revenue growth, but optimizing for gross margin and ultimately net margin is important. That you have packaged IP. We see premiums being paid for companies that have either packaged technical IP or packaged process-based IP based on their target market. That you're specialized. And this aligns well with Microsoft's go-to-market strategy around verticalization. We're big believers, and we've seen this many, many times in working with our clients, that partners that are focused on a limited set or a vertical market grow the fastest, have the highest net income, and tend to draw the highest value in a transaction. And that you have a clear addressable market that you can articulate to a potential buyer. Discount factors, you need to make sure that you have leadership transferability. And I would say this is either about selling in or selling out. And so you should think about your role as a leader in the business. And either you've created sort of a second tier of leadership that will come along with the transaction if you're selling out, or you're prepared to sell in and play an active role in the new enterprise. That you have management experience, right? That the team has management experience. Very seldom will a buyer want to just buy the owner or the founder of the business and assume that they're going to be able to build around them. They want some depth. That you have some liquidity, right, in the business. That it's being run well, that you have a healthy balance sheet, okay, very important. The location of the business is pretty important, right? So when someone acquires a business, they want to, oftentimes location is a factor, whether that be regional or whether that be more multi-location. And I know Mark can talk some to that impact when he did his transaction. And that your offerings are mature. So a little bit about how to make it all work, and then we'll turn it over to Mark for his input directly. What to expect sort of in the M&A process. As you can see from this bubble chart, a little bit of an eye chart, it's a complex process to go from, hey, I think I might want to buy a company or I want to be a seller, ultimately up and through integration. And it's really the business case for why you need an advisor. Oftentimes, you need a great legal advice. You need to have good accounting and tax advice. And it's our opinion that you need a good deal maker or M&A advisor to help you navigate these tumultuous waters. There will be a little bit of negotiating and pushing and shoving associated with getting one of these deals negotiated. And frankly, it's best that you have someone do that on your behalf, because particularly if you're selling in, if you're a seller, or if you're acquiring another company where the seller's coming along, you have to work together when the deal's done. And it's important that you maintain the relationship through the negotiations so that you can really create a win-win situation post-transaction. A little bit about successful transactions. They're really about culture fit, strategic fit, and financial fit. And when we talk about culture fit, if there's any single reason why M&A transactions after they're done come apart, it's because culture fit was not vetted properly. And that has to do with business philosophy, core values, sort of the customer care philosophy, and employee care philosophy. Those things have to be in alignment if you're going to be successful with a transaction post-close. Strategic fit is sort of assumed, right? Can 1 plus 1 really be greater than 2? We often say that 1 plus 1 has to equal 3 or more. That has to be clearly articulated and has to be discussed with a potential seller if you're a buyer, or you as a seller need to see that from a buyer in order to get a deal done. There has to be good process alignment, and if there's any IP, that has to be able to be leveraged across a transaction when you do a deal. And obviously, financial fit has to work. We have a broad range of EBITDA multiples here. Again, as we talked about before, EBITDA multiples are not valuations and vice versa. This has everything to do with your level of profitability, your degree of strategic fit with a potential suitor, and the deal structure that we talked about before. How much is upfront cash versus how much is delayed payout. And the buyer needs to get an internal rate of return greater than 20%. This is an extremely important point, and one that we've seen organizations very effectively implement in their vetting of a potential transaction. If a buyer can get to less than a 5-year payback, which is essentially an IRR that's greater than 20%, then they should do the transaction. And you have to have a willing buyer and a willing seller with deal terms that make sense. If a buyer can't get to that number, it's very unlikely that they will do the transaction, or frankly should. And then sort of making it all work, post-merger integration. Being able to plan how you're going to integrate a business, or what the long-term plan is for integration, that should start at least 6 to 8 weeks before closing is critical. A wish is not a plan. You really have to have a very rigorous post-merger integration plan. We here at Revenue Rocket have a process that we've developed over the last 15 years or so called the post-merger integration charter, which focuses on all of the details required in order to do integration in a meaningful way. And again, I'm sure Mark can comment a little bit on this in his section. And without further ado, we're going to turn it over to Mark Seeley, CEO of Intellinet.
Super. Thanks, Mike. Appreciate the introduction and the opportunity to share with you guys here today. So a quick perspective on Intellinet, at least my background. I've been an entrepreneur in 4 different companies. Even the early days of high school, was trained at Anderson Consulting for about 5 years. But I've been with Intellinet for about 20 years in my career, and had ran operations, sales for a season, actually did a software startup underneath Intellinet for a while. But the important point here is I know we've got some founders and some leadership team members. I was not the founder, and that brings a different perspective towards how you grow and potentially some of the thoughts about what's possible. To that end, I took over the role of CEO about 7 years ago, and I'll share with you guys our journey over the last 7 years in a fairly transparent perspective in our path. So before we do that, I'll give you a quick perspective of who Intellinet is. We're a purpose-driven management consulting and technology services firm that really drive or desire to implement value-creating solutions that build a material impact for our clients, mostly in this Microsoft ecosystem, but a lot of it might be around strategy, digital transformation, and back-office transformation as well. So we'll look over our 7-year journey since I was CEO, and I'll give you a perspective, even an early profile of Intellinet in the Microsoft ecosystem. So we were founded back in 1993, and that was the early days when MS Mail and Windows NT were out there, and email was going to revolutionize the world, and to some extent it did. But started off in the mail and unified inbox perspective. We continue to grow as Microsoft continued to expand that back office philosophy and sort of the product sets to be able to continue to do that, and partner with Microsoft and MCS a lot. From that, we were fortunate to be able to get a lot of great recognition and awards from Microsoft, even 2 times on stage for Worldwide Partner of the Year for Solutions. I have a fairly deep customer base and project list, but for the most part around transactional services. It was the next rev of Exchange or SharePoint or SQL or back office systems management tools for Microsoft. And it was a very transactional type business, albeit with some very large global companies. And the operating belief back then for the company in the 90s and the go-go days of the 90s and early 2000s was take care of the customers, take care of your employees, and the rest will take care of itself. Well, it's a great philosophy on paper, but in some sense, and from a transparency perspective, all of us, probably or a lot of us, have been through several recessions, whether it be the dot-com issues of 2001. For us, it was really the convergence of a recession in 2008 to 2010 here in the U.S. or globally, and the convergence of cloud transformations and really displacement of a lot of our whole business. And I'm sure a lot of you on the phone potentially can empathize or maybe even sympathize or empathize with the model of we were a great family business type mentality, about 14 million, that shifted down to about 7 million as our clients said, hey, what we've got is enough. Whatever that model was, SharePoint, SQL, et cetera, the version that we have is fine. We don't need to upgrade because we're cutting back on all costs. And so we actually shrunk the business, or let's call it the business shrunk in and of ourselves. And we're at a point with some debt on the business and really a pivot point within the industry back in that time period to either realign our business model and our go-to-market messaging around truly value creation, not just systems implementations, or really call it quits, shut the doors, or really integrate into another company at a low valuation. And so we made the bold shift to be able to say, let's go all in the cloud. In early 2010, we did a lot of the BPOS work with Microsoft for some global companies and shifted our business over the last 5 to 7 years towards a transformation message, not just a transaction message, where the model towards business, digital, and back office transformation really is the whole theme that we're taking to market. And the nice thing is that the results from it have been pretty strong to be able to take a business-centric approach, not a technology-centric approach. Revenue has had a great uplift, upwards of about 4.5 or 5x. Our compounded annual growth rate has been about 24% from some of those shifts. And the nice thing, albeit we took on debt in 2010 and had times where in a transaction-based business of purely just upgrades, it was our revenue and our profit was based on the Microsoft cycle. And we'd be cheering on Microsoft to release a new version of a product so that we can make money and keep the business going, and really have shifted the model to be able to be transformation-minded. And from that, we're fortunate to be able to have a pretty good streak of profitability. And also, over the past several years, a nice profitability EBITDA model as well. And so that's all great from what we do and how we're going, but really the perspective of why we wanted to take this Intellinet 2.0 concept was really purposely to shrink our footprint, to be able to be industry aligned, to be able to be transformation minded. And we've been very fortunate to be able to have several different awards, as you'll see there, and the national worldwide stage, and even more models from Microsoft as they're a key partner with us in the transformation message. However, we're not as much partner-led as client-led and sort of strategy-led. And the perspective of purpose, really, we were fortunate enough to be able to make a bet on the business and have it pay off. And so after we paid off some of our debt, both from internal issues as well as from the M&A that we did that helped us to get further revenue growth, we really made this whole purpose-driven mentality come to life. And really, in honor of our 150 employees at the time, this past year, fully funded the build out of 115 homes in Haiti. And this whole profit with a purpose mentality of what we're trying to do that really fuels our growth and passion for what we're doing is a huge part of our vision and story. So I'll give you a perspective as we dig into that. The 4 pillars for growth are really what Mike and I have termed really this profitability best practice for SIs, is that we didn't have in our early model, we didn't really have profit as a key driver. It was profit minded. It was really take care of the customers. But profit's key, a plan, process, and this whole purpose orientation is critical. So I'll give you a sense for our evolution as a firm. And really, again, it started as a traditional Microsoft SI, as many of you on the phone, and had some great years and had some lean years. But if you use 7X or 7 million as a benchmark, we really had to look ourselves in the mirror and say, how do we take this landscape change that Microsoft didn't initiate but was fully on board with? And are we going to cower, or are we going to really rise up to the equation towards our go-to-market? Process was crazy critical. So focus on the marketplace, focus on those things that we did very well. So candidly, we did everything in the Microsoft patch, and then we decided to shrink back down and really focus on what we're doing. We then had a pretty good process model that we could then incorporate an M&A for scale. Crazy important to get values alignment, but that helped to increase not only our top line overnight, but also our EBITDA through doing that well. This whole theme of then taking not only a post-merger integration kit from concept but to reality came into play. And we're fortunate enough to be able to have one of our largest deals over this past year be a full-on model where both of our teams really helped to drive value to sell well over or close to a $10 million project or program through the best practices of both our Northeast and Southeast groups that came together. And really in this cycle now that we're on this repeat cycle of landing, and probably here in the next month or so, our second acquisition, and really accelerating the growth model and finding that happy medium of what's the right EBITDA target for us as we grow our top line revenue. The key here is just clarity is critical, and leadership is as well. So I'll give you on these two last slides here the context of what we've learned in the M&A model, and also prepare things that you can prepare for within your M&A journey. Defining your path, I think it's very critical for you as you're investigating the model of where you're going to put your chips, whether it's continuing to grow solo or looking at acquisitions or being acquired. It's clear to understand what your path is, what your desire is, because some of the investments that you would make maybe in a back-end PSA or ERP may not be needed if you're looking to be bought. It's just have a good process, but not a heavy material investment there. Understanding the people that you're going to be working with, as well as the corporate persona. Mike talked about this a lot. That was crazy important for us to be able to select the right fit, because doing that first M&A well, which I would do 10 out of the next 10 times, choosing that right person and right corporate persona is critical. There's obviously multiple CEOs, multiple CFOs, back office, digital leads, et cetera. And it's really understanding the strengths, being honest with yourself on the strengths of what you have and what makes the right fit for the business. Mike talked about selling in versus selling out. And this is people-based business where IP may be interesting, but it's not the majority of the work. So having a team that continues on is important. As a CEO, it's really understanding that your role will change, not might change, but will change, and being mentally ready to adopt towards what that looks like. Communications are very important towards the idea of the checklist and post-merger integration. Mike talks about a very structured model within the 3 to 6 months that we did as well. But I'll tell you, it's an ongoing model to continue to have a one corporate persona versus the old company and the new company. Just really insist and enforce that one company mentality happens. And then finally, preparing for the M&A, just get a sense that obviously understanding your process and systems are going to be crazy important to be able to understand where you're going from a growth mentality. And once you have that defined, then use M&A as an add-on, not really as a replacement for making the tough decisions. I think a lot of times suitors want to make sure that you as a management team will really embrace change and understand how to make tough decisions before they bring you on. Having the right board of advisors and a M&A advisory team is very important to understanding that you've got a third-party perspective going alongside with you to help you navigate not only the valuation, integration, but the marketplace challenges and opportunities. And candidly, to just remind you on why you're doing this, because it's a tough hurdle for a lot of founders as well as management teams to do this. And so it's really the clarity of the what and why to be able to understand your targets and triggers for doing this deal. And then finally, understanding the better together scenarios. It really has to be this complementary culture. If anything, that is the first and foremost thing that you should look at. Financial fit will be there, but merging two cultures together to where it truly is an embedded model. Looking beyond great talent, but really will this team fit together is critical to success. Value creation across the full spectrum. And really, the last thing I'll do is we took this point of really fast growing, then fast declining, then really fast growing again with this profit with a purpose mentality of whether it's at the back end of a transaction or really as a persona within the company. As a people-based business, it's really important for us to, as entrepreneurs, to really make our businesses to be more than money, and really the transactions as well. So proud to be able to share the story, and Mike, I'll turn it back to you.
Thanks, Mark. I appreciate it very much. If I didn't say so already, you're our favorite client. No, just a little bit of client humor there, but we certainly do value our relationship, and I guess we kind of got to the wrong slide here. I apologize for that in the transition. Give me just a second, and we'll get back to where we were. Certainly a compelling story, Mark. I know that you guys have built the business in a very meaningful way over the 7 years or 8 years or so that you guys you've been at the helm. I'm, all joking aside, honored to have worked with you and helping you realize your vision for the firm to date. A little bit about what's next. I want to give you guys a couple takeaways to manage sort of your thinking around this presentation. It's really important, and Mark mentioned this, to be clear about your path, and whether it's exclusively build or build, buy, and or sell. And I think as you think about growing your business and ultimately growing that business both through organic growth and or acquisitions, and then ultimately monetizing it, that you have clarity about your approach and your timing. I think it's easy to manage a partner business and sort of just take it day to day, but not have, not raise up and look out into the future and have clarity. So I'd encourage you guys to think about that as you're continuing to grow your businesses. Be ready or get ready. Very important, situation. I think if you're not in an optimal position in the business as it relates to both organic growth and or acquisitive growth and or selling, it's important that you guys consider doing that. Know what you bring to the table in an M&A conversation is important if you're going to have one. Profit drives value and gives you options. And it's important that you clean up your balance sheet if you haven't already done so, and then just go get it done. A little bit about a special offer for Revenue Rocket, and then we're going to get into Q&A. If you'd like to learn more about this, let us know. But essentially, it's an M&A readiness review. We'd be happy to help you guys figure out whether now's the time for you to buy or sell a business. And we're doing so at a 50% discount. So essentially, you can get a valuation of your business and determine if now's the right time. If you want more information on that, feel free to drop me an email. And without further ado, I'm going to turn it over to Ginny to manage Q&A.
Wonderful. Mike, Mark, thank you so much. What a great session. And we've got some great questions coming in, but keep them coming, folks. So I'm going to start with one that I was expecting, because when I first heard this term, I did not know what to think about it, which is we had a few questions about EBITDA. I'm really understanding, EBITDA versus revenue versus valuation. How do you understand that term, and what does a partner really need to know about that to be successful in thinking about what their valuation might be?
Sure. I'll jump in, and Mark, you can fill in the blanks as a partner who is managing this every day. EBITDA is earnings before interest, taxes, depreciation, and amortization. So essentially, it is your earnings or your profit. And it's important to think about it as the single key driver for driving value from a valuation perspective. Mark, I don't know if you want to, add some additional thoughts about EBITDA versus gross margin versus revenue in your business, and maybe add some color.
The only thing I'd say is that it is a purpose-driven mentality to have profit as your driver. Again, that's the first thing in our vision statement, is a profitable growing company. And so it's key towards what we look at in acquiring, and obviously it's key towards the valuation of your business.
in terms of thinking about, resources, if someone's trying to figure out their EBITDA, et cetera, are there places you would suggest that they go to get help determining that? Is there a calculation that you recommend that they use for that?
Well, clearly their accountant can help, right? I think there's several resources really in the industry that can help as it relates to the standard chart of accounts that I think make sense. Many of you guys may have heard of Paul Dipple. Paul has a very prescriptive chart of accounts, as do some other advisors. But I would start with your accountant and talk to them about what is the best way to manage and measure revenue, both gross margin or gross profit and EBITDA, and make sure it's industry standard.
All right, excellent. So the next question we have, what are some sources for a partner to determine the market growth rate?
Wow, that's an excellent question. There's a variety of resources, both from Gartner and IDC, that I think they both do an excellent job of determining the various subsector growth rates. And Microsoft also has a variety of resources on MPN that can provide you some context of what various areas of the business are growing and at what rate. Certainly, if you just do a little digital ditch digging online, you can find many additional sources of this data. Some of the hot sectors, of course, are, business analytics, security, et cetera. There's other areas that are slower growth, which you certainly can research, but they range probably from 2% year-over-year growth to upwards of 22 to 23% year-over-year growth based on sub-sector within the industry.
Fantastic. We do have one more question around EBITDA, which is, are there typically any adjustments for owner salary or compensation in those EBITDA calculations?
Yes, from a sales perspective, there are adjustments. And the best way to think about, oftentimes these are called owner add-backs. In owner add-backs, the litmus test you should use is that those add-backs would not continue after an M&A transaction. So I know a lot of people like to ultimately throw in their own salary, and they say, hey, I'm going to deduct my salary, and I'm going to deduct this and that. Well, in essence, only if you're going to not sell in or not be there after the transaction would that be an appropriate add-back. So, however, if you have a vehicle that maybe you won't write off post-close, or you have had maybe excess owner benefit and things like travel, or maybe you're paying for other perks that you would in the business that won't continue post-transaction, those are applicable owner add-backs.
Yeah, I think that's key to understand. Obviously, from the accounting perspective, the EBITDA, there may be reasons for tax consequences or tax purposes that you would have some write-offs of certain things. But the one thing that we did is, and it may be against even our tax accountants' perspectives, is we said we want to run this thing fully as a business, not as a family business. And there's a big shift between the mentality of what's good for the owner and what's good for the model. But the reality of having that discipline that you run down the path, and then having that material profit to be able to invest back into the business, which we've done so in a material way, is very important to be able to understand what that looks like and the rigor of what would be required in a secondary type integration or in a public offering or whatever else in the future. So that's one discipline that we did.
Excellent. So we have another question here. Do you have any recommendations for a Microsoft partner that has multiple companies in multiple countries?
As a case study, Jenny, could you fill that in as an example of a company that has multiple companies in multi-countries? I mean, we certainly know many partners that have that scenario, but is it a case study for them to look at, or is it an example of a firm that's successfully done that?
Recommendations on how they might go about M&A, considering the multi-country and having more than one company that they're maybe working with.
Hey, Mike, let me take a first step. Yeah, I'll
Sure.
take a first stab at
Go
that,
ahead.
and it really gets it from a practitioner's perspective. So one of the things that we looked at in devising our strategy as a operating company, as well as what we looked at for integrations into others, is to fully be clear on what we do in the marketplace that was fairly sectored, as well as keeping in mind that at some point, what would be our facet or our element that could be easily absorbed by another company. And so a lot of times, the more broad you are, the harder it may be for a company to do that. That said, if you're doing some sort of a very focused niche of AI within, one or two different or three different industries, a global scale would be crazy important. So I think it depends on that mix between what you're doing from an offerings and really this concept of would the potential suitors value that multinational model, or would they only be interested in a portion of that asset?
Yeah, and I would say that, to get more nuance around that, feel free to email me or my partner Reed with a more detailed question. We certainly can give you some examples of partners that have done that successfully and/or answer the question more granularly one-on-one.
Yeah, fantastic. So next question, and this is one I was expecting. It has to do with how a partner would fund a transaction. So as a potential buyer, how are these being financed if the balance sheet cannot support the entire transaction?
That's a good question. I would say that many of the transactions are being funded through debt. I think if the business case exists for you to do the deal, then clearly there is an opportunity to secure debt financing to do deals. We have seen that over time. There's very good programs, particularly for small businesses in North America through the SBA, to fund fairly substantial transactions via debt, as well as other financing vehicles. And when I say other financing vehicles, there's clearly other equity financing options, as well as, a lot of people are interested in equity financing. I think the thing to remember with equity financing is that it's generally pretty expensive financing. And if you can fund a transaction through debt, it might be better for you from a return perspective.
Fantastic. Got another question here. So what's the most important thing that a partner should be doing now if they're considering a sale of their business sometime within the next, even between 12 months and really, a few years?
Mark, do you want to take a run at that one?
Yeah, so I think being, again, very clear on what you do and what you don't do, and then operations such that your top line revenue growth and your material profit or EBITDA is defined as consistent and sustainable so that you can go. I think the best thing to do, most people say, I'll only sell if I'm in dire circumstances or my company is in disarray. I think the model acquirers, or sort of those that would acquire or bring in companies, really do look for gems and well-run teams and well-defined models. So again, focus on your plan, tighten it up from a model market or marketplace perspective, and run something that's very consumable, both understandable to your clients as well as consumable to another group. And then again, work with an outside agency and a board to be able to make sure that you've got the right strategy from an advisory perspective that can help you during that process and then through a formal process as well.
Fantastic. All right, another question we've got here. I've heard it's a seller's market. Is that true?
Well, it's clearly a active time in M&A, and we often say that this is probably as active a market as we've seen since the late 90s. Can you articulate whether it's a seller's market or a buyer's market? I don't know. I do know that certainly in the last 3 years, there's been some increased valuations that we've seen in the market. And I think that, that may portend that it is a seller's market, although I would look at those valuations very cautiously. because there oftentimes is a lot more to the story. Clearly there's premiums that are being paid by public companies or companies that plan to go public. There's opportunities for enhanced value creation around that more variable payout type view. And in the end, that makes those multiples look like they're really higher or been buoyed higher than they actually are. And so you have to, look sort of pretty deeply to understand whether we see increasing multiples or we're just seeing people that are more confident about future value taking more risk in their sale. So I'd say in general, now is a good time to sell. If you had to pick historically and looking at maybe a 20-year history, there seems to be a lot of transactions occurring, but everyone's situation is different, and obviously you should look at it and make some sense of it objectively before you would make the decision to do it.
Perfect. And I'm going to ask one more question, but we're looking for a pretty short answer on it so that we can do our closeout. We're getting close to the top of the hour. But one question I do want to ask is, how do you go about finding a company to buy or sell your business to?
Well, that's certainly where companies like Revenue Rocket come in, right? I think there's a great advisor community in the Microsoft partner channel. And it's certainly what companies like Revenue Rocket does, right? We find and we think of ourselves as a matchmaker both on the buy side and sell side in M&A transactions. And it's part of the value that M&A advisors in general provide is helping you find the right transaction for you that fits all those key three areas, right? Strategic fit, cultural fit, and financial fit.
Mike, I think that's right on. And again, we did leverage Mike for full transparency on our process, and it went great. And so we appreciate that outside perspective and network perspective. The one thing that I'd add to that is obviously don't let it short circuit your connections and reaching out with other executives and really almost, let's call it, dating other partners for a season to make sure that you've got a good sense. And so invest in the partner community. We actually got the initial lead from the group that we ended up integrating with from our Microsoft East Regional lead, VP. And so that perspective, understanding what you want to do, networking, and again, using an M&A advisor is critical there.
Fantastic. Thank you guys so much for that wonderful Q&A. If anyone does have any questions that they didn't get answered, please do go ahead and send an email to smbin@microsoft.com and we will follow up with you. Just going to quickly go through some next steps. We do have a ton of more resources for you. First of all, please do join us next week, either for the buy or for the sell side session, or for both if you're still trying to figure out exactly what you want to do. And then also, Mark just mentioned that being part of the Microsoft community is extremely important for finding other partners who are interested in this. So we do have 2 new groups. We've got a LinkedIn group and a Yammer group on cloud growth and profitability. So if you're interested in hearing more about these type of subjects, please sign up for those. You can submit your questions to us at Microsoft, to your peers, and it's an opportunity for us to share with you other resources that are coming out like this from Microsoft and for you to share your feedback on what else you could use. Also, just going to do a quick shout out. We do have a survey for today's series. Your feedback is extremely important to us and does help us make our programs even better. So please fill out the survey if you have a quick minute. Finally, there's a bunch more resources that Microsoft has. Obviously, go visit Revenue Rocket's website. If you're interested, do sign up for that special offer. But then also make sure you check out the Modern Partner homepage. There's tons of amazing resources that Microsoft has available to you, from cloud profitability benchmark assessments to cloud practice playbooks if you're looking to start a new practice. So make sure you're familiar with those resources. And with that, I'm going to go ahead and close out the call for today. Mike and Mark, thank you guys so much for this fantastic session. We're so excited to have you on. Really appreciate all of the great Q&A that you answered today, all of the great content that you had. And thank you so much for everyone who joined us today. We hope to see you next week. Have a great rest of your day.